So let us look at the same example which we did using the direct method. So instead of direct, we'll use an indirect method to calculate the cash flow from operations. So just to reiterate the same example, we had the income or the sales as 650,000, we had the gross profit as 350, selling general and administrative as 140,000, taxes as 40,000, and SG&A expense were to include 14,500 for the depreciation, and we were also provided the balance sheet items for the respective beginning period and the end of the period. So let's start with the indirect method, which is basically step 1 is identifying what is the net income and adding it up. Now step 1, net income needs to be calculated from the information above. So we start with sales. Sales is 650,000 here. We have the cost of goods sold, so this should be 300,000. That is why gross profit comes out to be 350,000. Then what do we have? We have the selling, general and administrative expenses. This is 140,000. So this comes out to be 210,000 here. This is your EBIT, and interest provided here is 0. So your EBT is equal to 210,000, and taxes is 40,000. So what do we get in terms of net income is 170,000. So this is a net income. Step 1, start with your net income. What was step 2? Step 2 was to add back all the non-cash items. So here in this income statement, what do we know is that SG&A actually included non-cash item, and this non-cash item was to an extent of 14,500. So this is 14,500 was included as an expense, which was depreciation and amortization expense. So we must add this back, 14,500. So step 3 essentially meant that look at your income statement and see if there are any non-operating items. You remember non-operating items like gain on sale of land, because sale of land is not an operating activity, it's a investment activity. So there is no non-operating items which are included in the income statement. So step 3, the addition or deletion would be 0. What was step 4? Step 4 was to identify the balance sheet items and see whether the impact is positive or negative from the cash flows point of view. So let's look at this table here, which has been provided from the point of view of balance sheets. So we know that this is current assets, inventory is current assets, and here accounts payable is current liabilities. So this is the first step, identify whether it is current asset or current liability. Now look at the change. Account receivables have increased by 16,000. Inventory has decreased by 13,000. Accounts payable has increased by 7,000. So when current asset increases, we know that cash goes down. So the cash impact here is that it is negative 16,000 here. What about the current asset, which is inventory? Inventory has gone down. So the cash impact is that cash has come in to the system. Accounts payable, current liabilities has increased. That means cash has come in. So here the net impact is again 7,000. So what we note here is that the net effect of all three activities here would be how much? 16,000 and plus 20,000. This would be 4,000 as a positive net cash flow impact. So step 4, we have the number as 4,000. So what we need to now do is just add these items here. Net income 170,000, depreciation amortization non-cash item, and the changes in the balance sheet item, which is basically related to operating items on the balance sheet, that is 4,000. So this becomes 170,000 plus 14,500 plus 4,000 here. So this comes equal to 188,500, and this is the same number that we got using the direct method. So this is how an indirect method can be used to calculate the cash flows from operations.